Hello friends, in this session we will talk about the two readings of the FRM Part II's current issue subject. Both the readings relates to the climate change. That's why I will cover both the readings in the same video session. First reading, that is reading number 4, is the climate change, physical risk and the equity prices. Reading number 5 is about the green swan event. So these are the two readings. And here our focus is mainly on the climate change effect on the equity prices. So we are not concerned about the rest of the effect because of the climate change. We are mainly concerned about the equity prices. And because we are the risk managers, financial risk managers, so we have to think from that perspective only. So first I will start with the just brief idea or overview of the climate change. Then we will move into the physical risk and the transition risk. We have to cover transition risk in the latter chapter, but I will cover here itself. First, the climate change. What is climate change? Because of the excessive emission of the halogen and the CFC gases, ozone layer is depleting. And because of this ozone layer's depletion, global temperatures are rising, and this rise in the global temperature is resulting into ongoing, this current situation, it is resulting into the ice melting. Ice is melting, and resultant or consequence of the ice melting is the sea levels are rising. And then we have the other consequences like the irregular rains. We have also health hazard consequences because of the excess exposure to UV. It is said like the it will result into the cancer and so on. So all these risks are there. So this risk of ice melting, sea level increasing, irregular rains, excessive temperature and so on is categorized under the physical risk. Now, this excessive emission of halogen and CFC is because of the industrialization. That's why regulators are asking industries or the manufacturers to reduce the carbon footprint. And to reduce the carbon footprint, manufacturers need to move to the new technology of manufacturing, and they have to leave the old technology. For this transition, they have to spend a lot of funds, and this will create burden on the balance sheet. So this is the transition risk. So transition risk is manufacturers need to transit from old procedures or the old process of manufacturing to new process of manufacturing to reduce the carbon footprint. This is transition risk. And physical risk is like rainfall, irregular rainfall, rising temperature, rising sea levels, and so on. Okay, so this is the basic introduction. Now we'll start with the reading number 4, the actual discussion, and then we will move into the reading number 5. First is the channels through which the climate change affect the financial stability from the perspective of the physical risk. So here we have to only focus on the physical risk and not on the transition risk. First, current climatic disaster. Second is the future climatic disaster. Now, current climatic disaster. So overall global temperatures increased by 1.1 degrees Celsius, and this is related to pre-industrial levels. Pre-industrial as in before industrialization happened, when we were working, when the laborers were producing the goods. So that was pre-industrialization. Now industries are producing the goods. It is industrialization, right? And the climate scientists attribute this to man-made greenhouse gas emission. CFC and the halogen are the greenhouse gases. Climatic hazard and the extreme weather events can turn into disaster that causes loss of life and capital stock, as well as disruption of the economic activity. Say flood comes in the area where data servers are located for any data server company like the Amazon. Okay, so what will happen there? So obviously they will not be able to sustain, or there will be disruption in the economic activity, which will result into the losses, right? Very obvious. As a result, they are source of physical risk. So climate risk is source of physical risk. As the frequency and the severity of the climatic hazard rises, the resultant losses can be significantly higher. A lot of companies prefer insurance for all these disasters, okay, climatic risk disasters and so on. Even all the natural disasters are covered there. But if this happens because of the climate risk, then this will happen globally, and insurer will not be able to repay the losses, right? Will not be able to commit or will not be able to provide the claims. So insurer could suffer from underwriting losses. Banks could face the lending default. Lending default is if the borrower faces the losses and if he is unable to repay the loans, obviously this will result into the default. This can result into firm value decline, that is banks and insurance and other companies as well. Hence, The credit underwriting and the market risk are related to the climate change. For insurer, government might come out with the bailout packages, but this will result or this will create a distress for the governments. Okay, so this is the first learning objectives, first part, current climatic disaster, then future climatic disaster. Future as in which will happen in future, right? So investors put premium on the assets with the physical risk. Premium as in, we all know, for taking risk, investor puts the premium add-on, right? So this premium add-on is also for the physical risk to climate change, resulting into lower valuation of the asset, right? So if the premium is added or it is increased, then automatically it will result into the higher discounting rate. Higher discounting rate will result into the lower valuations. Deriving premium add-on for long-term climatic risk is complex task. Currently, there is no exact methodology. How will you predict what is going to happen in the future, right? For the normal valuation, we take some assumptions. We assume that the sale prices will increase by this, the supply will increase or demand will increase by say 10%. And based on that, we use all these assumptions in the financial models, and based on that, we do the valuation, right? But for the climate risk, to account for the climate risk effect in these financial models, we don't have any measures currently. This is about this particular part. Okay, so deriving premium add-on is very complex task and hence subject to valuation error. Climate change can affect in many different ways, which is not accommodated in the equity prices. Remember this, okay? So currently it is not properly accounted for in the equity prices, meaning equity prices are overstated. How climate change, next learning objective is how climate change and climate risk have affected equity prices and equity valuations. Again, this is very fact specific reading, so you have to remember points here. Climatic events have significant impact on the equity prices, which may affect the financial stability. Overall, average impact of the climate events on the equity prices has been small. Remember this. Has been small, but with high deviation. This is a testable point. Based on the empirical data, overall impact on return was low, up to 1%. Okay, minus 1%. In some cases, stock indices were not impacted by disaster, while in some cases, it saw a decline up to 8%. Impact of non-life insurance are as follows. Developed countries, noticeable impact. Non-life insurance as in the insurance for all these events, natural disaster events. So impact on non-life insurance. First, in developed countries, there is noticeable impact. Okay. So the link is very simple. If the natural disaster occurs, then company will face losses. The insuree will face the losses, and insurer have to provide for the claims, right? And this will result into lower valuation for that insurer. But this happened only in the developed countries. Okay, so noticeable impact. In the emerging and the developing economies, no such impact due to following reasons. So there was no such impact due to following reasons, and you are supposed to remember these reasons. First, because in the emerging and the developing economies, insurance market for the non-life insurances is not that developed. First reason. Insurers do not underwrite claim relating to the disaster policy or claim disaster policies often. Okay, there are maybe limited but not very frequent. Then if they underwrite the non-disaster or non-life insurance or the natural disaster related insurance or climate disaster related insurances, then they reinsure it. Okay, and if they are doing it, then it is through subsidiary located outside the economy. So these are the three reasons. Okay, nothing to explain here. If you have any doubt, you can again comment and ask me. Then impact on the valuation, equity valuation. It is difficult to account for the impact of climatic risk in the valuation of equities due to uncertainty of the event. Analysis of the various factors have shown that there is no correlation between changes in the climatic hazard occurrences and the equity valuation, meaning we don't have the specific models, or this particular climate change effect is not properly accounted for in the financial models. That's why we don't have any correlation here. Regression analysis indicates a positive coefficient but not statistically significant. Evidence suggests that equity valuations, not prices. Again, in case you get confused, this is about the valuation, okay, not about the prices. Do not consider equity valuations, do not consider the climate risk, and valuations are overstated. On the other hand, bond accounts for such risk. So in case of the bonds, we are able to see a proper correlation. Okay. So meaning bond accounts for, or the bond prices accounts for the climate risk, but equity prices don't. How country characteristics such as insurance penetration meaning how much insurance exists in the economy, okay, and this is calculated as a ratio of GDP, and the economic development impact the extent to which the climatic disaster affect the equity prices. Insurance penetration is calculated as the multiple of non-life insurance premium over the gross domestic product, GDP. There is also gap in climate risk insurance, even in the well-developed countries. That is, only 2/3 of such losses are being insured. Fine. Empirical evidence suggests that the government aids and funds for reconstruction in case of major disaster, which minimizes the negative effect of the equity. You can state this particular reason. Remember the reason of why, maybe this is the reason why financial models or financial valuers, the analysts, are not accounting for the climatic risk, because they think that government will make up for the losses. For overall market, there is strong correlation between the level of insurance penetration and stock market returns immediately after the major disaster. This is about if the insurance penetration is high, meaning if these like climate risk are properly insured, then market will return to its normalcy after the climate disaster. So there is high correlation. High penetration, immediate recovery. Okay, so proper recovery. The results are even more pronounced when looking at a very large losses and the left tail. With the sovereign rating, 1 point, this is a point, just remember it. With the sovereign rating, 1 point improvement increased overall market return by about 0.2% and the banking industrial returns by 0.3%. Sovereign financial strength and the insurance protection are crucial for ensuring the financial stability. Why are we talking about the sovereign rating here? So if government has to provide for the losses incurred because of the financial disaster, it might result into decline in the government rating or the sovereign ratings. Okay, so remember this. So this is about the reading number 4, very limited discussion. Then we have the reading number 5, the Green Swan event. So title goes like the Green Swan event, central banking and financial stability in the age of the climate change. So first we have the difference between the Green Swan event and the Black Swan event. So what is the Green Swan event? What is Black Swan event? I will start with the Black Swan event. Black Swan event are the events which are unexpected and rare with the huge impact and cannot be protected. This particular term, Black Swan term is, or Black Swan event term, is coined by or was coined by the Nassim Nicholas Taleb in his very famous book Black Swan Events. Okay, so historically it was assumed as there are no black swans, and then in Australia they discovered the black swan. So at that time it was assumed that there are no black swans, meaning there is not going to happen, like there will be you won't see any like disaster or the rare event, right? But it happened. So we are talking about a black swan event, talks about that particular event. So what are the properties of black swan event? So event which is unexpected and rare. So here when Nassim Nicholas Taleb wrote about the black swan event, it is not just about the disasters and the risk, it is about the all unlikely events. Okay, then the huge impact and cannot be protected. Okay, example, terrorist attack. And in distribution terms, you can call it as a fat tail or negative skewness event. Now, what is green swan event? So if this is the black swan, okay, so all these type of events, the rare, unexpected, huge impact and cannot be protected, then this is the subset of green swan. So green swan event is the events like the black swan events, but specifically which relates to the climate change. Okay, you can attribute it to the climate change. The term derived from the black swan used in the context of the climate risk. Extreme outcomes and cannot be predicted. Climate risk based on the black swan event. Example is physical risk and the transition risk. This is just a note. Weather-related damages due to climate risk are irreversible, but losses due to financial risk can be reversed. Now, climate change threat to price stability. We have the few key points. Supply side shock. That is, what is supply side shock? After the physical risk, you or say the producers will not be able to supply the goods, specifically the agricultural and the energy assets. Okay, so if there is a flood, all the agricultural crops will be lost, and if it is lost, then you won't be able to supply it. This is supply side shock. Supply side shock could lead to the price hike. This can become more common and huge. Next is the lower output, again in the supply or in the goods, and demand shock, sudden demand, because we have seen in the COVID crisis, like there was sudden demand for the groceries and other stuff, okay, food and all like that. So demand shock, lower output and demand shock. This is the situation. Could lower the individual wealth. What will happen here? So if you have lower output and increased demand, price will increase, there will be a huge inflation, and individuals will use their wealth to buy it, and this will result into lower individual wealth due to more spending. Overall impact could result into negative correlation in inflation and the output. Okay, fine. Next is following the implications of the irreversible climate change. First is the stagflation supply shock that monetary policy could not fix. What is stagflation supply shock? That is sudden increase or decrease in the supply. Then inflation shocks by climate shock need global measures. It cannot be fixed by one country or the one region. And assuming the central banks can achieve price stability again after this particular event happens, this raises the question whether they could adequately hedge against the green swan event. Okay, how much they will be able to protect their citizens or the organizations. So that's the question. Now we have two types of risk: physical risk and transition risk. We discussed both the risks. Again, just for the information, transition risk is unknown impacts from switching to low carbon products that is from high carbon emission products to low carbon, to reduce the carbon footprint. Switching might affect the standard asset like the fossil fuel. Example, electric cars. Okay, so we are switching to electric cars. All the governments are pushing for the electric cars, and the result will be it will impact the fossil fuels. Could see impairment and might threaten the overall financial stability if changes happens too quickly. Now here, remember, transition risk is also about, like, if the changes, this transition happens too quickly, then a lot of assets will be impaired immediately, and then this will threaten the financial stability. If it happens too slowly, then it will result into the climatic risk. So risk is on the both the sides. So a goal is to balance this. Physical risk and the transition risk are interrelated. For example, rapid change might lower the physical risk but increase the transition risk, and vice versa. Secondary impacts of the physical and the transition risk: credit risk, market risk, liquidity risk, operational risk, insurance risk. I don't think we need to explain anything because you already got the idea. I'll just quickly read it out. Climate change may affect the profitability of the firms and result into the lower credit worthiness. Eventually, increase in probability of default and loss given default, LGD. Falling asset value affect the collateral value. This is the credit risk. Then market risk, obviously, natural disaster or climate risk related disaster will affect the market and then prices, right? So if it affects the market, then you will have the market risk. You can account for and measure it by the climate war. What is climate war? Climate war is you will account for only the climatic risk event in the risk side. Then liquidity risk, obviously, in case of the risk, if there is a stress in the market, even because of the natural disaster, the climatic risk disasters, automatically funding will be lowered and this will result into the liquidity risk. Okay. Then operational risk, you already know. Operational risk is any risk which is not the market and the credit risk, and now the liquidity risk as well. But again, it relates to the physical risk, like the floods, irregular rains. Everything is covered in the operational risk, right? So we don't have anything to discuss here. And then the insurance risk. Insurance risk is, again, insurer will face the risk. That is the insurance risk. Insurance risk may increase for the insurance and the reinsurance companies due to the physical risk. Then we have the climate change measures. Risk, time horizon, system requirement. You're supposed to remember the key points here. I will start reading the key points. I will tell you if there is anything to explain. Climate risk should be accounted for in setting regulations and financial stability oversight. So this is a regulator's job. Regulators should step in and they should design the process which will account for the climate risk. To the extent that there are reliable models for predicting future conditions. And you can't work on such models. It is very difficult. It is very difficult to derive the models which can estimate and quantify the future impacts of the climate risk. And also hedging is difficult. How will you hedge this if you can't quantify it properly? For quantification or for hedging, you need proper quantification, right? And even if you go for the insurance, insurer will face the losses and he won't be able to settle the claims. That's the problem. Then time horizon. Time horizon is a very specific point. Here we are talking about the climate change is going to affect the coming generation. It is not going to affect us tomorrow itself. Okay, it will at least take 30, 40, 50 years, right? And in 50 years, those who are the companies, okay, or the individuals who are running the organizations, they don't have any direct incentive. Okay, the direct incentive of saving the future generations from this catastrophe or the disaster. In order to save the future generation, they have to incur losses now. And obviously, humans are very selfish and we are not going to do that, right? I'm not being cynical, but yeah, we all know the truth. Catastrophic event of the climate change will put the coming generations into the risk, which offers no incentive to current generation and provide remedy for it. System requirements. For successful transition to low carbon global economy require on the understanding of greater uncertainty involved in the process of maintaining long-term climate and financial stability. Require understanding. Okay? And climate stability should be thought as an important international public good. And maintaining climate stability will require global monetary and the financial system. Okay, so these are the measures. So again, very easy basic discussion. So make sure you remember the key points and we are good to go. So that's all about the two topics of the current issues. See you in the next session. Bye bye.